Okay. Good eve good evening, Mr. Shiu. Welcome to class. So today, can you hear me, Mr. Shiu? Please can you confirm if I can hear me?
I can hear you, sir. Good evening, sir.
Okay, thank you. So today we'll be concluding the additional part of it of the financial statement, okay, so that we can move forward. So basically, I want to explain this. That was what I want to explain the bad debts and provision for bad and doubtful debts. So bad debt is actually as a what's called um, the debt that is no longer recoverable. You know, an organizations normally carry out business and they sell on credit. So if they sell on credit, there are probably possibility that the client or the customer will not pay the money due to the company at a particular point in time. So if that is actually if that occur, then we call that what we call that the bad debt. There are other times also that part of the credit that we have sold will be paid. And if that's paid, we call those people good debtors. We call them what? Good debtors. It means that those people are what? They are good customer of us. But if the client or the customer are unable to pay, we call them what? Bad debtors. Now, in our industry, as an accountant, it's possible because of the experience over the years. That's what we call doubtful debt. Doubtful debt is actually that you are not sure. You're like 50-50 if the client will pay or not. And thus, such is what we call doubtful debt. So they are in accounting, we normally make provision for it. We normally make provisions because we are trying as much as possible to prepare financial statement that will represent the company, not overstate or understate the present condition of the organization. So these are the things that we consider. Okay. So bad debt. So I've explained that. So that's why any firm that saves on credit is bound to have three types of what debtors. Name the good debtors, the doubtful debtors, and the bad debtors. And I think I've explained that. Okay. So after that, okay, what are the accounting treatments? There are accounting treatment that you need to know. Now, like I said, that this is actually what they will ask you. These are what they can test in your exam, and you find under additional information. And once it's found under additional information, and you know how to treat it, you have no issue, but to come out with flying colors. To come out with flying colors. So what are the accounting treatment? Bad debt is actually written off. Bad debt is actually written off on the debtor's account, and debtor's account is also referred to trade receivables account. So bad debt is written off because the reason why we normally write off bad debt is because so whenever we make sales, we normally add it under our revenue. So if that's what we have thought that is revenue before, is no longer revenue, then we need to remove it from our revenue. And that is why bad debt is always what? Written off from the debtor's account, and also what? Uh used to reduce the revenue in form of expenses. In form of expenses. So that was what the bad debt. So the balance of the bad debt will now be transferred to the profit or loss account to use to reduce the expenses. Then for the provision for doubtful debt, under that provision for doubtful debt, the way we treat it is that the amount for what we have an account called provision for doubtful debt, and there are two ways you can treat that. Is that we take the second lane for okay provision for doubtful debt. If you have it, you have it to be credit item. So you debit item and you credit the other. So you can credit, is that you credit the bad debt account, or you credit what? Uh, or you credit trade receivables account. So either of the two, or you write it off to either of the two. That's what you do. Okay. Let me explain that. Let me explain that. There are amounts set out in actually in the profit to provide for bad debt and doubtful debt. It means that it's a provision, a provision that you have stated that is you are doubting that they will pay back, so you make provision for it. It can be on percentage. Let's say 5%. If it's 5%, then it means that the trade receivables that you have after you have removed your bad debt, you now find 5% of the figure. When you find out 5% of the figure, that amount will be found under your provision for bad debt and doubtful debt. But the second leg there, we go to your expense account, which is what profit or loss account. Are you with me? So at the end of the day, that the account provision for doubtful debt is always what used to reduce the trade receivables, and is always shown in your statement of financial position, which is also called balance sheet. It's always shown in the statement of financial position. So now, after that's the way we treat that. So let's just look at the accounting entry. Let's look at the accounting entry for that. The entries for provision for doubtful debt is as follows. In the first year of raising provision, what do is you debit your profit or loss account because you are trying to reduce the element of your initial revenue that you have recognized before. You are trying to reduce your revenue with that amount. Then the other one is what is to credit your provision account. You credit your provision account. So that's the way you do it in the first year. That's first year. Then in subsequent year, you now do what? Or if it's increased, you have to know if it's increased, because it means that at the end of the year, you calculate your under provision for bad debt. You now compare the one at the beginning. If it increases, if it actually increases, then it means that the difference here will be debited to profit and loss and credited to provisions account. But if it reduces, it means that you have overstated your provision earlier on. Then it means that you now credit profit and loss account and debit provision account. If it decrease, it means that you debit provision account and credit profit or loss account, which means that it's going to be under your gain. Okay, it means that it's going to be under your gain, gross profit, because it means that you have overestimated your provision as of last year. This time now you are declaring a lower provision, so you need to remove the difference, or you need to add back the difference. And that is the only condition in which we can find provision for bad debt under credit column for profit or loss account, under credit column for profit or loss account. So whenever you are giving subsequent year, you need to check it with the beginning of the year and the end of the year. The differences is what is taken to your profit or loss account. Then the balance of your profit provision for bad debt, the balances on your provision for bad debt will now be used to reduce your trade receivables under statement of financial position, under statement of financial position. Also, there are some textbooks that will not show you this, but for the completion of your knowledge, we talked about provision for discounts allowable. Provision for discounts allowable. This is actually a provision that states that the customer will take advantage of the discount. It means that if you give a customer 15 days for them to if they pay within 15 days, they will enjoy a particular discount, probably 5 discount or 6 or 10 discount. Then at the end of the year, at the end of the month, you still have some customer that maybe they bought their item in let me say on the 25th downward of that month. It means that if they count their own 15 days, it will fall in the following month, and they will still going to take advantage of it. So if that's the case, we normally work, or the accountants also make provision for discounts allowable. They make provision for discount allowable to state that this amount will still be will still serve an expense as against the total money that we are expecting. And that is actually so we have that account as well, provision for discount allowable. This is written off on the debit side of profit and loss accounts and credited to where? To provision for that to the discount allowable. However, in the order to calculate the provision of discount allowable, it is necessary to first deduct the provision for bad and doubtful debt, if any. So we have to first of all deduct the provision for bad and doubtful debt. Well, after we have deducted that, then we now use the balance. Then we now calculate provision for discount allowed on the balance. On the balance. That's how you do it. Okay. Now, after all talks, so let's look at a question, and let's use a question to illustrate better. Okay. Let's use a question to illustrate better. So question 1 says that the following information has been extracted. The following information has been extracted from the book of Adams Limited on 1st April 2018. The provision for discount allowed was 5,830. The provision for bad debt was 2,234. Discount allowed during the year to 31st March 2020 was 18,824, and bad debt written off was 4,832. On March 19, debtors amounted to 425,052. The provision for bad debt is to be based upon a specific provision of 5,052 and the general provisions on the remainder at 1%. The provision for discount allowed is to be 2%. You are required in the exam. Calculate bad debt account. B2. Provision for bad debt account. 3. Discount allowed account. 4. Provision for discount allowed account. 5. Statement of financial position. Extract as at 31st March 2019. So we are required to provide solution on this. So the first one is that what? Because they told us that the following year is extracted from the book, okay? And they told us that they gave us the balance for provision for bad for discount allowed. They also gave us the balance for provision for bad debts, and also they gave us discount allowed during the year. They gave us discount allowed during the year, and they gave us figure for bad debt. So they now asked us to prepare bad debt account. They asked us to prepare bad debt account. So if you want to prepare the bad debt account, what we will do is you open bad debt account, then you do what? You create debit the account. So you debit accounts because they are the one what receiving the item. They are the one receiving an item, and their expense account. And expense account, if you want to increase it, what do? You debit such account. So you debit the accounts, and the other account that will be what credited is trade receivables, because trade receivables account is the account that holds the total amount of money that the company is expecting the customer to pay. So if I'm expecting a customer to pay me 20,000, and the customer, I know that the customer will not be able to pay me out of that 20,000, I know I'm not going to get 5,000. The next thing is for me to reduce my what? To reduce my 20,000 by 5,000, so I can know the actual amount that is what that is due to be payable, or that is the actual amount I'm going to collect from my customer. So that's why we normally what? The second leg always go to where? The trade, the receivables account, in order to reduce the amount of what? Of the trade receivables, or to reduce the amount of trade receivables. So we have it to be debited there to receivables with the amount of 4,832. 4,832. So after that, we now go to, so let's paint this so that we know we have addressed that. Then after that, we now go to what? To trade receivables. Do we have trade receivables here? We have it here. Then we have that to be what? To be at this amount here, which is coming from the bad debt. Now, since we have opened trade receivables and we have the balance for that year, then we come here and put what? And put the actual what? The actual trade receivables for the year, which is 425,005. The reason why we put sales here is because the second leg will be found in the sales account. That's why we have sales here, because the second leg will be found in the sales account. So after that, because let me show you the figure that I just used now, so you understand how I arrive at that. So let me just show you so that you understand how I arrive at that. So can you see that? Can you see it here? It says that on 31st March, the debtor amounted to what? To this figure. That's why we use the opening what? The sales figure for that year to be 495,052. Okay. Now, the next thing for us to now do is that we are still working on it, right? We are still working on it. So we now open provision for what? For bad doubtful debt. Provision for bad debt. We make provision for bad debt. Now, the question is the following information given to us. They told us that provision for the bad debt is what? 2,234. 2,234. And this 2,234 is opening balance. And I said provision for bad debt have what we call what? The credit what? Credit balance. Credit balance, or less otherwise stated. It's always have what? Credit balance, because it's even used to reduce your trade receivable. So it's always having credit balance. So we put amount here, credit balance. So it's our opening balance. So we have that figure here, 2,234. Then after that, we now move to where? We now move for what does it say? The thing is to now post the provision for the year. We need to post the position for the year. So how do we post that? We look up here and look at, do we have, did they give us provision for the year? They told us that the bad debt written off. We have used this figure as well. We have used this figure. And I told us that the bad debt, okay. The provision for bad debt is expected for the provision for bad debt is to be based upon a specific period of 5,400 and general provision on remainder of 1%. The provision for discount allowable is 2%. So now, after you have done that, then I'm actually looking for the next one to use, which is the expense account. Okay. Now, based on that, so they told us that the what's it called? They told us that the provision, they gave us a percentage of provision. They said that the provision for bad debts is to be based on a specific provision of 5,000 and a general provision on the remainder at 1%. A general provision on the remainder at 1%. It means at this point, before we can attain the provision for bad debt, we need to first of all to attain our trade receivables. We need for us to attain our trade receivables. So we open our trade receivables and we look at what are the discounts allowed, because discount allowed are also used to what? To reduce our trade receivables. So the discount allowed on trade receivables is this amount. Okay. So we credited what we are going to do is you credit the account with that amount. We credit that account with that amount. I'm trying to get my calculator open to ready. Okay. Now that we credit that account with the amount, so we have our closing balance to be 4,400 and what? 401, 396,000. 396,000. Now going up here, they told us that the general provision is what? The general provision on the remainder at 1%. At 1%. So we need to calculate that. So how do we calculate that? We do 1%. So now our trade receivables is what? Is 4,401,396. After we have that, we now what? We have to remove the element. So I'm trying to make a trying to find out something here. Okay. So the remainder of the discount allowed. Okay, I think I get, okay. Now, like I said, that what you need to do is that we need to calculate a particular thing, that is, we need to look at the closing balance against the opening balance. Okay. Now they told us that they told us here that the amount here should be 5,000. 5,000. Okay. They told us here that it should be 5,000, that the general provision for bad debt is 5,052. That 5,052. They now told us, and a general provision on the remainder, at the remainder at 1%, on the remainder at 1%. So how do we get that? We come down here and look at the closing balance. The closing balance is 401 396. Then after that, we scroll up to check the general provision that we have initially. So we have that to be 5052. Then after that, we multiply that by 0.1. After that, we now add what? The initial figure given to us. And that will give us the total of 9,015. 9,015, which is the closing balance. Is the closing balance for the provision for bad debt. Now let me explain that again. What I'm saying is that the provision for bad debt is to be based on the specific provision of 5,052. They are telling us that the specific bad debt given to us is 5,052. Now, they now told us that a general provision on the remainder at 1%. Now, on the remainder, what does that mean? It means that we need to remove this 5,052 that we have from the remainder of this, from the trade receivables, because the trade receivables that we have at the moment is 401,396. So if we do 401,396 minus, you need to minus the specific provision first, which is minus 5,052. That will give us 396,344. This is the remainder that we are going to charge the 1% on. This is the remainder that we're going to charge 1% on. So if we press your times 0.0101, that will give us 3,963.44. And this is what is part of the provision for bad debt. So we now add it with the specific with provision, and that will be plus 5,052, and that will give us 9,015.44. But it has been approximated to be 9,015. Now, if it's 9,015 that we have, that is our closing balance. This is the total bad debt that will be used to reduce our trade receivables. Now that we have this, the next thing for us to now look at, okay, the closing balance is 9,015, while the opening balance is 2,234. It means that our provision for bad debt have increased over the year, and that is what the increase there we now is an expense. Then we have the difference. So the difference there is as a result of 9,015 minus 2,234, and that will give us 6,780. So 6,781. And this 6,781 is not an expense that we're written off to an expense. You have two ways of doing this. You can either write it off to profit or loss account, or transfer it to your bad debt account. Now, if you transfer it straight to your profit or loss account, it means that on your profit or loss account, you'll be seeing what we call provision for bad debt account. You see provision for bad debt. But if it's transferred to bad debt, you are not going to see provision for bad debt there. What you're going to see is bad debt. It means that the totality of the figure is what you'll be seeing in your profit or loss account. So in this situation, we are transferring to where? To bad debt account. And that is why we have it here to be provision for what? Provision for bad debt to the 781. And this total addition here will be written off to profit or loss account. It will be written off to profit or loss account. And if we add those two together, it will give us 11,613. It will give us 11,613. Now, after you have done that, the next thing for us is now to move into discount allowed accounts. Discount allowed account. So we start with the figure given to us that the balance for the year is trade receivables based on, we have done that on that. So let me just paint this. So we have 18,824. You know, discount allowed account is an expense. It's used also to reduce the revenue. So it have debit balance. It also have debit balance. Then after we add 18,824, the next one is now for us to make provision for it. So looking at this one, the provision for bad debts, then we have the opening. Can you see we have the opening? We also have the credits always on the credit, like I said, it's always on the credit. So we have the opening to be 5,830. We have it to be 5,830. After we have that to be 5,830, we now ask ourselves, what is the closing balance? What is the closing balance? So how do we get the closing balance? The way we get the closing balance is if we go back to the question, it says that the provision of discount allowed is what? Is 2%. The provision for discount allowed is 2%. Now, if that is stated, then you come down here and ask, okay, what are you going to multiply 2% with? It will be 401, which is your trade receivable. You know, when I started the class, I said that your discount provision for discount allowed is always calculated on the remainder trade receivable account after the provision for doubtful debt have been deducted. After the provision for doubtful debt have been deducted. So we have that to be 401 396 minus what is our total provision for doubtful debt. That's 9,015, and that will give us 392,381. Now, after we have gotten that, the next thing now to also multiply it by 2%. If multiply it by 2%, and that will give us 7,848. 7,848, and that is our closing balance. It means that is the balance that will be used at the end of the year, and that is what we call as our closing balance. We will now compare our closing balance against our opening balance to know the amount to expense or the amount to what the gain back as under the provision. Now, if you look at the opening balance is 5,830. If you look at the closing balance is 7,840. It means that there's an increase. There's an increase in our provision. And if there's an increase in our provision, there are two ways in which you handle this as well. You can either transfer the balance to your discount allowed account, or you transfer it straight to the profit or loss account. If you transfer it straight to the profit or loss account, what you will see on the display of that is what we call, what you see there, you will see on profit or loss account, you see provision for discount allowed account. You see provision for discount allowed account. That's what you see. So we have that to be expense account. So we look at the difference. Now the difference is 7,880 minus 5,830, and that will give us 2,018. And this is what we affect or we eat our profit or loss account. So here we are transferring to discount allowed account. That's why we have it under what? Under the discount allowed account. It will be 2018. So then add it up together. The final one will now be transferred to where? To the profit or loss account. It now be transferred to the profit or loss account. So under the profit or loss account, on the expenses side, you now see discount allowed 20,842. 20,842. Now, the next thing for us to now prepare is we are asked to prepare an extract. we are asked to prepare a statement of financial position extract. So how do you do that? This is what we are going to, it means that an extract means if I'm preparing, assuming I'm preparing my full statement, how will this information be displayed or disclosed on the statement? How will it be disclosed on the statement? And that is where we now have, you put your trade receivables, your trade receivables balance, because the trade receivable account is 401,396. Okay, so we put that there. After that, you now put your provision. You less your provision for doubtful debt. You less your provision for doubtful debt. You now less your provision for discounts allowed. In case you don't have this, it will not be there. But in case they don't give you provision for discount allowed, it will not be there. You just stop at provision for doubtful debt. But we ask you to compute provision for discount allowed, then it will be found under this financial position. Then you now compute. When you compute, it means that this amount is the reasonable amount that you are expecting to receive as regards to trade receivables. And in your financial statement of position, you must show the workings like this. So you normally have like 3 columns, 3 naira sign on the, if you are using T format, you have 3 naira sign. If you are using vertical format, you can have 2 or 3 naira sign. Now, if the final sign, if the final naira sign is for the total computation, then the first sign, all this computation will be on the first sign, and your final figure will now be transferred to the second column. So this one will be on the column. The final figure will be transferred to the second column. That is how we treat bad debt, provision for bad debt, and provision for discount allowed. Now, I'm mentioning provision. There are some materials, or there are some questions that will ask you. They will not mention provision. What they will say is allowance. And if that is the case, it means that allowance and provision are the same. Please don't mix it up. Don't try to say, this allowance, they are saying, no, allowance for doubtful debt, provision for doubtful debt are the same. They are the same. Okay, now after that being said, let's look at question 2, then we move to the next adjustment. Now, question 2 says that Ibaru Nuri has been in business for several years, dealing in the sales of second-hand clothes. During the year ended 31st October 2019, he presented the following information relating to debtors. So they gave us information relating to debtors. They say debtors, including the bad debt. So it means that this figure that we have here, bad debt is what is included. Bad debts, what they are included. Then after that, they now give us the figure for bad debt as well. And the figure for bad debt is 3,850, 6,000, and 300,000. These are what? These are provision for bad debt for as at October 2017, October 2018, and October 2019. You are required to show the above information for the year ended 31st October 2017, 2018, and 2019 in the following accounts. So I expect to prepare 3 accounts: the trade receivables account, the bad debt account, and the statement of profit or loss account extract. It means that we are not preparing the full complete profit or loss account. What you are just expected to prepare is the extract. Okay. Now, if you want to start with that, the first thing you have to do is trade receivables. And trade receivables is you have to remove the element of bad debt from it. You have to remove the element of bad debt on it in order for you to have the actual trade receivables. Once you are done with that, you now credit the trade receivables account with the bad debt. You credit the sale to your with the bad debt. No, sorry, you are not going to remove it. If you remove it, it will be double reduction. So you are going to transfer that 45 to your what? To your trade receivables. Then you now move your bad debt. Once you now move your bad debt, you now give you your closing balance. So in year 17, we have it to be what? 4.5. That 4.5, then we now have the bad debt to be what? To be 1.2. So we now have, okay, if that's the case, of 4.5 minus 1.2 will give us what? will give us 3.3. Now, this 3.3 is the figure that will now be carried over to year 2018. So under year 2018, we have the balance brought down to be 3.3, and then after that, the balance, the bad debt as well, we always reduce it. We always reduce, because if we have the balance to the year, then we are trying to reduce it to the year. As we are trying to increase it, it will be under the debit side. But if we are reducing it, it will be under the credit side. So now, then the credit sales. They give us any credit sales for the month. Let's look at the credit sales for the month. This is the credit sales for the month, for the year rather. Any credit sales for the year? Let's look at that. Now they now told us that what debtors. This is okay. Now as at this end, I have 4.5, right? I have 4.5. As at 2018, I have what 8,750,750. Now look at, there's a difference here. It means if my opening balance, if I remove 1.2 from 4.5, that will give me what? That will give me 3 points. 3 points. 3.3. Now give me 3.3. Now, if you give me 3.3, it means that I've added this 8 at the end of 2018. I'm having 8.750 again. It means that I've made additional credit sales for the year 2018. I've made additional credit sales for year 2018. Then I will not say 3.3 minus 8.750. 3.3 is my what? Is my balance brought down, minus 8,750 will give me the actual credit sales that I've made for the what? For the year 2018. For the year 2018, and that will give me 5,450,000. It means that you have this increase, because I'm saying that my credit sales at the end of year 2018 is 8.75. Now, if it's 8.75 and my opening balance is 3.3, then it means that what? I've made more credit sales. I need to find the difference, and the difference will not be what? The credit sales. Then after I have that, the addition of this debit side is greater than the addition of what? Of the credit side. So I will now do the difference, which is 8.75 minus 3.85, and that will give me 4.9. Now this 4.9 is my closing balance. It means that at the end of 2018, the total amount of my receivables is what? Is 4.9. So I come here and I put it to what? 4.9 as well. I put, okay, my balance brought down is 4.9. Then if that's the case, what's my bad debt? As given me the question in the question, I have it to be 6.3. So after that, I'll now look at, fine. What is the question is telling me that at the end of year 2019, that is what? That I made, that my total debt or debt figure is 12.2. They say my total debt figure is 12.2. That if that is the case, it means that I've added one credit sales in the year. So I'll say 2.2 minus 4.9, and that will give me the difference of my credit sales, which is 7.3. After I have that, I'll now say, okay, fine. My debit side is greater than my credit side. I need to find a difference. My difference will be the total trade receivables, or the closing balance of trade receivables at the end of 2019. So I'll now say 12.2 minus 6.3, and that will give me 5.9, and that will give me 5.9, which is my closing balance. It means at the end of 2019, my closing balance is 5.9. So if I want to calculate any provision at the end of 2019, it will be on what? On 5.9, because that is my balance. That is my balance. Now, after that, they ask us also to prepare bad debt. So if you want to prepare your bad debt, all what you need to do is just to what? To transfer. Because bad debt is an expense account, we will not have balance brought down or balance carried down. Every balance at the end of the year will be written off to the profit or loss account. Every balance of expense account, they are written off to profit or loss account. And that is why we have here That is why we have year one. That okay? Sorry. Okay. That's why we have year one trade receivables to be 1.2. We have it to be 1.2. Then after that we now what? At the end of the year we have do a total write-up to profit or loss account. We now write the balance will be written up to 1.2. Then after that year two, we are now adding it. We're having a quick another fresh one. For the balance, what bad debt, profit and loss account as well. We have the figure to be the same. We repeat the same exercise in year three. Then we what? Write it off to profit or loss account. Then we are now required to now what? To now prepare the statement of profit or loss extract. Now, it means that every bad debt that will be written off the profit or loss account will showcase in your statement of profit or loss account extract. And that's why we have it here. Year 2017, we have the figure here. Year 2018 as well. Year 2019, we have the same figure. We have the figure here as regards the same figure with the bank, with the bad debt account is what we can find under our statement of profit or loss account. Profit or loss account. Okay, so that is actually about that. So let's see. Yeah, we have more questions here. We have question 3 and question 4. So we indulge you to practice question 3 and question 4. If it's not clear or you don't have, you are not sure about your solution, you can chat me up. Then I will review your workings and probably what if it's wrong, I'll let you know. Well, if it's correct as well, I will applaud you. Okay, so try to practice question 3 and question 4. Try to practice question 3 and question 4. They are important. Okay, so I'll give a minute. If you have any question, please raise the point in which you ask your question so I can clarify some areas that are not clear. So do you have any questions so far? I'll just give you some minutes to just look through what we have done. So still waiting for the question. If there's none, I will move on within a short period. Just okay. And I believe you are preparing so much for exam. Your exam is already here. The exam is already here. Okay, so if there's no question, so let's move to the under material. Let's move to another material. Okay. I believe you can see my screen and hear me. Okay, so this one we're talking about IS2. IS2 is a standard. I always talk about IAS, that's International Accounting Standard. And these are the rules. These are the standards that state out rules and regulations on how to prepare or address some transaction. So how to prepare or address some transaction in the financial statement. In the financial statement. So we're looking at IAS2 because in your syllabus, you're expected to look at, I think, 5 or 6 standards. You are expected to look at IS1, IS2, IS8, IS16, IS7, and I think it's 5, either 5 or yeah, I think that 5, IS1, 2, 7, 8, 16. And one is what we call the one is what we call preparation of financial statement. The 2 is inventory. Your 7 is cash flow. Your 8 is accounting policy, changes in accounting estimates and errors. Your 16 is property, plant, and equipment. You expect to what? And also, so you expect to what? You expect to know all these. You expect to know all these standards. And I believe that my colleagues have taken you on IAS 8 at the same time as well. We are now on IAS 2. I've taken part of IAS 16, but my next class I'm going to take IAS 16, and at the same time I'm going to take a full comprehensive question on your financial preparation of financial statement. Preparation of financial statement. So let's go to IAS 2. IAS 2 is all about inventory. It's all about inventory. In an organization, there's always an inventory. There's always an inventory because inventory are the items that have been owed temporarily to be able to be converted into cash. They are the items that have come to normal or that are actually what we call for sales. They are the item held for sales in ordinary course of business. They are the item held for sales in ordinary course of business. So for example now, a company that sells cars there that they have there is what is their inventory, because the reason why they have the cars there is for sale. So you can't classify it as non-current asset. And inventories are actually found under current asset because they are convertible to cash within 12 months. They are convertible to cash within 12 months. So they are regards to what? To current assets. And they are also tangible. They are tangible. So according to the IS2, inventory is what? Is when inventory means tangible property held for sales in the ordinary course of business, in the process of production for such sales, or for consumption in the production of goods and services for sales. That's the way they refer to inventory. Any item that falls within this three can be regarded as inventory. If it's actually is old because of sales, because of the ordinary course of their business, at the same time in the process of what production for such sales. If you are actually what you are producing, you are converting from raw material to finished good, and in the process you are consuming it, those items also are regarded to as what? As inventory. Or for consumption in the production of goods and services for sales. We will now have the finished goods. You are now selling them for consumption because that's what we call inventory. So basically, from this one that I've actually mentioned, for my explanation on the inventory, then we can talk about that we have three forms of what? Of inventory. The term inventory includes stock. So we have three forms of inventory. The first one we have is raw material and the component. Raw material and its component. The second one we have is work in progress, while the third we have is finished goods. Finished goods. What do you understand by raw material and components? Raw material is when we purchase an item that is expected to undergo some processes to reshape the material or to reshape the item into another thing that will be useful for consumption. Please, when I mention consumption, I'm not saying everything that we can eat. Consumption means that everything we can use is not what we can eat alone. So when say raw material is what is the item that will still undergo some processes before it can be useful for the end user. Before it can be useful for the end user. Then the second one that we have is work in progress. Work in progress. What do you understand by work in progress? Work in progress are raw materials that are being worked on, but yet they are not fully available for the final consumer. They are still working on it, but they have gotten, maybe you have process 1, process 2, process 3, process 4. Now he has undergone process 1, process 2. He's stuck on process 3, and he still needs to move to process 4 before it is completed. That at that point that is in process 3 is being regarded to as work in progress. It means it's not yet finished. We are still what? We are still working on it. The another one that we have is finished goods. Finished goods is actually the goods that is consumable by the final consumer. It's consumable by the final consumer, and this is when when there's total completion on the on the material, and the material are be converted into what the customer can use. They require it to finish goods. Now there are some finished goods in some company, it serves as raw material in another company. So please, let's be careful of farming some things to finish goods and raw material. Because for example, now the raw material, the final product for Total or Aluminium is actually what the final product for them is raw material for another company. It's raw material for another company. So let us try to get the definition or the differences between the three. Then in case of manufacturing, and manufacturing is a special sector that we also need to take note of. So in case of manufacturing consign, inventory consists of what? Raw material, components, stores, semi-finished products, and finished goods. In case of trading consign, inventory primarily consists of what? Of finished goods. In servicing company, we only have inventory alone. We have finished goods. What we buy, because we are not processing it, so we just buy it, we use it, and that's all. But for manufacturing sector, that's manufacturing sector that makes of these three types of inventory. Now, what are the objective of inventory valuation? Now, it means that what are the objective? What are the purpose of evaluating inventory? Why are we monetizing inventory? Why are we attaching value to inventory? The number one is to determination of what? Of income. Determination of income is actually one of what? The number one. A major dimension of income. So a major objective of inventory valuation is the proper determination of income through the process of matching appropriate costs against revenue. When you talk about matching concepts say that the appropriate costs incurred to achieve the revenue should be matched against each other in order for us to achieve our gross profit or against our gross profit. You remember, or if you have reviewed some textbook or some material, you see that sales minus cost of sales will give us gross profit. Sales minus cost of sales will give us gross profit. Now, if that's the case, we all agree also that cost of sales is what? Is opening stock plus opening stock or opening inventory plus purchases minus what? Minus closing inventory. Now, in order for us to calculate our profit, we need to value our closing inventory. So when we're able to value our closing inventory, we need to value our closing inventory. So, and you want to value it because we need to know the amount based on the concept. The concept says that anything that cannot be monetized, is not what is not expected. That a money or value cannot be attached to it. It's not expected to be found in our financial statement. So that's why we normally value our inventory in determining our income. So closing stock is actually very, very important because the increase or decrease in closing stock will affect the what? We affect the profit. We affect the profit. And that is why we value inventory also is determination of financial position. Inventory is actually a very important item. It is to be shown as current assets in the statement of financial position at the end of the year. Is to know the value of what you have, the inventory that you have that will be easily convertible for a period of time in order for us to state appropriately the financial position of the organization, in order for us to state appropriately the financial, now for us to state appropriately the financial position of the organization. So that's why auditors, external auditors, do come and do what we call stock counts. They do stock counts in order to ascertain that what they have taken into their financial statement is actually the right figure, and they didn't pick the wrong figure to overestimate or underestimate the financial position. So method of recording inventory. There are basically two methods according to the standard of recording inventory. We have number one, we have the periodic inventory system, and we have the perpetual inventory system. So from the word alone, from the word periodic and perpetual, you should have an idea of what you expect to how the two method works. You know you should have the idea of how the two method works. So we have the periodic inventory system. Now, periodic inventory system, under the system, the quantity and the value of inventory is what is estimated by physical counting the stock at the end of the year and as of the accounting date. So in this moment, we normally do what we call what? When we have the opening balance, we will now do physical counting. We do physical counting to confirm. We do physical counting to confirm the total inventory that is left before we can now attach a value to it. Before we attach a value to it. In case of this system, certain items are physically counted, while others are weighted in kilos or in tons. It depends on the inventory. That we are considering here. There's some inventory that you just count them, while there are some inventory that you have to scale. You have to scale, and when you scale them, so you be and what you take them in weight. When you take them in weight, it will assist you to know the value that will be attached to it. For stock taking, we have what we call sheets that we use. You have to record it as an independent verifier. When you record as an independent verifier, you now go ahead. If you are in a manufacturing sector, the cost for that for each once you are doing the event count, and you have process 1, process 2, process 3, the cost at process 1 will differ from the cost of process 2. The cost at process 2 will differ from the cost of process 3 because they have underpassed some certain costs, So it will varies in that aspect. Another one that we have is what? So under the periodic, we just have the opening stock and the closing stock. Every other item as regards to inventory are found under purchase account. So we normally have purchase account under what? Under the periodic method to monitor the movement of inventory. But under the perpetual inventory, the system actually provides a running record of inventory on hand before under this method store registers are maintained. It means that this actually makes sure they have the store register to mark the movement. As things are moving out, they have their own account to show for it. And under this system, what we call the purchase account does not exist because every item purchased and every item issued out are found under inventory account. They are found under the inventory account. And it means that as you are taking it out, you are documenting it. As you are bringing it in, you are documenting it. So every information as regard to inventory can be found under the word, under the inventory account. So it serves as a way to control and to know how, where the issue is, what issue coming from. And the beauty about it is that it does not wait to the end of the point before it realizes that an issue has occurred, compared to the periodic. Under the periodic, any mistake or any stolen item will not be easily identified until the end of the year. So it encourages theft, losses, shrinkage, and wastage a lot. But under the perpetual inventory system, it helps to what? To address the drawback on the periodic system. We're able to address the product on the because at a glance, at the particular point, not by waiting on a year, you can itemize if there's theft or if there's losses or wastage of your inventory. They also carry out stock taking exercise to make sure that the balance of the stock taking is actually the same with the perpetual inventory system balance. If it's not the same, then that's a great area where you now start carrying out further audits. When you start carrying out further audits. So now let's look at question one. Let's look at question one and let's look at that. So question one says FCA trading had opening inventory of 220,000. Purchases during the year were 60,000. Closing inventory at the end of year 2 was 24,000. At the end of the following year, at the end year, the following entries are necessary. Show the accounting procedure using the two methods. So we are asked to show the accounting procedure using the two methods, and this method we are talking about is both periodic and perpetual. Both periodic and perpetual. So let's start with periodic first. So under periodic, the purchase account, like I said. So under that, we have the purchase account. So we have what is the opening inventory is what is 20,000. So we come under the inventory account, we put the 20,000 here. Then following that, we have the purchases during the year. So we create a purchase account, and purchase account hold the value. So we create a purchase account, and purchase account hold the value. So we have who is giving. Bank is one giving. So we credit bank and credit what? And credit purchase account and credit the purchase account. Then after that, we next say that the closing inventory at the end of the year is what? It's 24,000. So the closing inventory at the end of the year is 24,000. And it means that the closing balance will now be what? 24,000 under the inventory account. Under the inventory account. So after we have done that, the next thing for us is now to know that, oh, if that's the case, opening stock is 20,000. And this will be transferred. That 20,000 naira, because at the beginning of the year, it will be transferred to cost of sales. It will be transferred to cost of sales, which is 20,000. After you calculate that to be 20,000, that's okay, fine. What do we have again? We have 20,000 and 24. Okay, we have it to be 20,000 and 24. Add them together, it will give you 44,000. Then if that will give you 44,000, then the different 44,000 minus 20,000 will also give us what? 24,000. And this also is found where? Is found under the cost of sales. It's found under the cost of sales. You'll be surprised why we have two cost of sales here. The reason why we have two cost of sales here, let me explain, is that opening balance is 20,000. Opening balance is 20,000. Now, under your cost of sales, what do you normally have? You always have opening balance, right? This the cost of under the cost of sales, the opening balance that we have here is this figure. Then you always have what we call what closing balance again, and that closing balance also is also what cost of sales. This is the closing balance that we have under the cost of sales. This means that it has been transferred. This has been transferred to the what? To the cost of sales as closing balance. So this one serves as the opening balance, while this one serves as what? As closing balance. So now if you look at this one here, can you see we have cost of sales? After that, we have our purchases. Okay, we expect to start with our open inventory. Can you see? Because we have written it off, we have taken it away from inventory account down here. So we have the 20,000, we have the purchases, add the purchases. So we have added the purchases and less closing inventory. Can you see? We are less in closing inventory. That's why the closing inventory is on the credit side. It's on the credit side. Then after that, we have a what? Our balance carried down. How do you get our balance carried down? 60 plus 20 will give us 80. 80 minus 24 will give us 56. So our balance, our cost of sale for that period is what? Our cost of sale for that period is 56,000. It's 56,000. So after then the perpetual, like I explained earlier, I told you that perpetual does not create rooms. There's no rooms for purchase account under perpetual method. So what they have is inventory account. In that inventory account, every transaction as regards to inventory are found under the inventory account. So we will start with our opening bill figure from the question is 20,000. Then after that, they say we have what we may purchase. Who give us? Who give? Bank gave, right? And who is receiving? Inventory is receiving. So we have the inventory here to the world to be 60,000. That's inventory 60,000. What is the balance at the end of the year? The balance at the end of the year is 24,000. Now, if that's the case, if I have 20,000 naira at the beginning and I have 60,000 naira at the what at the end, so I purchased additional 60,000. It means the total inventory that I have or that I have in total for the year is 80,000. And I say at the end of the year, I now counted my stock. I valued it at 24,000. There will now be 80,000 minus what? Minus 24. So now give me the cost of sales for the year. It will give me the cost of sales for the year. And that is why we have what? 56 here. Now, if you look at it now, the what we have under the periodic is also the same thing that we have under the what? Under the perpetual inventory system. Also say under the perpetual inventory system. So these are the two-way system or method inventory system that we have to record them. Okay, these are the two. So your organization can pick one and leave it two, or they can pick the two. Okay. So let's look at question 3. Question 3 says Oniyale had operating inventory of what? Opening inventory of 100,000. Purchases during the year were 500,000. So they make a total purchase of 500,000 during the year. Inventory with the cost of 18,000 was returned to a supplier. That's a return outward. The total, you have already recorded it before the word that you receive it, but now you are returning back to the supplier, and that's what we call return outward. Return outward. Then after that, they told us also that what one of the purchase in the above amount was subject to an express delivery fee, which cost the company an extra 15,000 in addition to the above amount. That is carriage inward. Delivery fee is also was returned to supplier. One of the purchases in the above amount was subject to express delivery fee, which cost. Okay, that's carriage inward. Delivery fee there is carried inward. It means that carriage inward is the cost which we use to bring the inventory down to the company. But if you are taking the inventory down outside the company, is what we call what? Carriage outward. Now, carriage outward is an expense element, while carriage inward is part of what? Cost of sales. It's part of cost of sales. So now, after we have read that, it now said that Oniyale sold goods during the year which had cost what? 520,000. Goods which has cost 20. Oniyale sold goods during the year which cost 520. Goods which had cost 20,000 were returned to the company. They are returned to the company, and this is what we call what? Return inward. We value that we have sold before and later returned to us. That is what we call return inward. Just before the year end, goods which had cost 5,000 were found to have been damaged. while being handled by Oniyale staff. So now they ask us to what? What are the entries necessary during the period using perpetual method? So we are using perpetual method. You only have to use what? Just one account, which is what? Inventory account. Inventory account. Just give me a minute, please. Let me take some water. Let me refresh. Okay, thank you. So after that, we now have, okay, so let's prepare our inventory. Let's prepare our inventory record. So we have the inventory here. We have the opening balance. They give us the opening balance to be 100,000. Yes, we are good to go. They give us to people to be 100,000. That's good. Then the next thing for us is to what? Is to now look at the purchases. They make purchase of 500,000. Now, if they make purchase of 500,000, it means our inventory will go up. And since our opening balance is found on the debit side, you put it on the debit side, and that is purchases. Purchases of what? Of 500,000. The second leg will be found on bank. If it's paid, it will find on bank. If it's not paid, it will be found under trade payable on the credit side. Okay. And then after that, we now see that inventory which cost 18,000 was returned to the supplier. Now we are out of the what we purchased. We now know that 18,000 was actually returned to the supplier, and we have recorded it before that we actually will receive an item of 500,000. Then we are now returning back. That's what we call what return outward. And then it means that is a deduction, is to reduce the total purchase that we have made. So we are going to find it under what? Under the return outward, under the credit side, return outward, because we are what? We are using it to reduce the total purchase that we have made. And if we are using to reduce it, it has to be on the opposite side, not on the same side. Then after that, we have one of the purchases in the above amount was subject to an express delivery of 15,000. Now, under your what? Under your cost of sales, under your cost of sales as well. Before you can arrive at cost of sales, carriage inward is another factor that is added because its cost is part of it. It's part of the cost of the inventory. It's part of the cost of the inventory. So it will be what? It will be added to it. And once it is added, then we now have what? So we have to add it. Cost of what? Because the reason why we are incurring it is because we purchased the inventory. So we have the cost, carried inward cost. So we had it. So I want to add it, it's going to be on the what? On the debit side, or the debit side. Then after that, it says that only only sold goods but during the year, which had the cost of 520. No, they give us the cost. Remember, okay, I think we now the next one. So they give us a cost, and the cost is what? Is 520. So that is what we call cost of goods sold. Cost of goods sold. And that's 520. That's cost of goods sold. Then after that, also they say that goods which had cost 20,000 were returned to the company. So goods that worth 20,000 were returned back to the company. So what does that mean? It means that you have actually what? You have actually made sales before. You have actually goods which had cost 20,000 were returned to the company. They are returned to the company. Now this one is talking about the goods that we have actually what? They make sales before. The goods that we have made sales. I said that, oh yes, we have made sales, but it was now returned. If it's now returned, what does that mean? It means that we need to debit the account. Return inward. We debit the account. We debit the account of 20,000 because we are adding back to our inventory. They return back to the company. So our inventory we what? We jack up. Our inventory we jack up. So if our inventory is increasing, we debit the account. We debit the account. Then I said also that just before the year end, which had cost of what? Of 5,000, we are found to have been damaged while being handled by Oniyale staff. Then that's okay, fine. If that's the case, 5,000 just at the end of the year have been damaged. That means that we are carrying a figure in our inventory account that is not expected to be. So we need to remove it, and that is what we call normal loss. Normal loss, because it's possible that in my old 100 inventory, maybe 10 or 5 of it what might got spoiled. And also normal loss is what is a law that falls within the approved provision of the approved provision of the organization. So if we fall within it, we now call it what we call it normal loss. We call it normal loss, and that will be 5,000. We call it normal loss. Then after that, we have done everything. So the next thing for us is now to compute. If we compute everything on the debit side, it will give you 6,635,000. But if we compute everything on the credit side, it will not give you. There will be a difference there. Now that difference that you have there is going to be what? They minus it together. It will give what we call 92, and the closing balance. It means the item, the inventory at the end of the day, that what we have as an inventory, the what is 92,000. 92,000. 92,000. So after we have done that, so let's look at okay. I think after that, let me know if you have any questions so far on IS2. If you have any questions so far, please just send a question just for a few minutes, just like 2 minutes. Okay, so in case of absence of what questions, so let's move on. So we have returned to the method of valuation in inventory. Now we said we only state the reasons why we should value income and say also inventory. And one of the reasons is to determine the income, and at the same time also to determine the financial position, because inventory is part of the item that is used to determine the financial position. So what are the valuation? How do we value the inventory? The valuation of inventory can be extremely important for financial reporting, because the valuation affects cost of sales. So we have to be very careful, because it affects cost of sales, we affect profit, it affects the total asset in the statement of financial performance. It affects that the things also it affects. And once your cost of sales is affected, it's going to affect your gross profit. And once your gross profit is affected, it's going to affect what? Your net profit. And once your net profit is affected, it's going to affect the equity section. At the same time, also, it's going to affect the equity section. At the same time, it's going to affect what you call, it's going to affect the current asset, total asset. It's going to affect the total asset. And if it affects those two, it means that the total statement of financial position will not be able to rely on it. You will not be able to rely on it. So then also let's look at inventory must what? So inventory, according to the IS2, inventory must be measured in the financial statement at the lower of cost and net realizable value. At the lower. It means that if the cost is 10,000 and the net realizable value is 5,000, it means that what you use to value the inventory is 5,000, because 5,000 is lower than 10,000, and that is found under the net realizable value. We are going to explain each of this method one after the other, but please, you need to know this, that inventory must be measured in the financial statement at the lower of cost and net realizable value. Net realizable value. Now let's move to cost of inventory. Let's move to cost of inventory and let's try to explain that. Now, according to IS2, historical cost is the aggregate of what? Of cost of purchase, cost of conversion, and other costs incurred in the normal course of business in bringing the inventory to the present location and condition. Now, what I'm talking about is what? What do we call cost? What do we call cost? So IS2 says that cost is actually what we call historical what? Is historical spending or the historical amount that has been spent aggregate on needs on the cost of purchase, the delivery cost, the conversion cost, every other related cost that has been incurred in the normal course of business in bringing the inventory to the what? To their present location and condition. Then we can regard all these costs together and make it to form the cost that we use to value the inventory. That we use to value the inventory. So cost of purchase comprises of what we call purchase price, less what? Less discount, trade discount, plus duties and taxes, freight, inward, and other expenditure directly attributable to acquisition. That's what cost is all about. So if I purchase an item now of 20,000 and a cost of me moving it from that point to my warehouse will be added onto it. If I employ anybody or I actually what? I involve anybody to come and work on the inventory before I can use it, then that also will be part of my cost. That will be part of my cost. So the valuation of inventory at cost price will be in conjunction with the realization concept. According to this concept, revenue is not realized. Revenue is not realized until the sales is complete and the inventory is converted into either cash or account receivables. It means that if you convert it to cash, it's no longer with you. If you convert it to account receivables, the asset, the inventory, is no longer received, no longer with you. Example of them is what we have the example of them is what we have the inventory. We have the inventory that goes with that will have sales. So I make sales on credit. That's as well example of inventory. That's why I say that is classified as cash sales or as well is classified under the account receivables. It's found under the account receivables. Let's look at question 3 to explain that or to drive home the explanation. So question 3 says KCE buys goods on overseas supplier. It has recently taken delivery of 1,000 units of component X. The quoted price of component X was 1,200 per unit, but KC negotiated a trade discount of 5% due to the size of the order. So which the discount? Remember, I said, okay, let's continue. The supplier offers an early settlement discount of 2% for payment within 30 days, and KCE intend to achieve this. Import duties of 60 naira per unit. 60 naira per unit must be paid before the goods are released through cousin. Must be what? Through cousin. The supply, okay. Import duties of 60 naira per unit must be paid before the goods are released through custom. Once the goods are released through custom, KCE must pay the delivery cost of 5,000 to have the component taken to his warehouse office. Calculate the cost of inventory. Like I said, every cost that relates that you incur for transporting, for purchasing, and transporting the inventory from the point of purchase to your warehouse or where you need them, such costs are added together to get you to total cost that will be used to value the inventory. That will be used to value the inventory. So let's look at the solution. We have what we call purchase price. Now, this purchase price will always be less of what? Less of discount. less of trade discount, less of trade discount. So what they have given to us here is that the purchase discount, the purchase price. How many units are we buying? We are buying 1,000 units. We are buying 1,000 at what rate? 1,200. 1,200. But what is the discount given to us? The discount given to us is 5%, which means that instead of us to pay 100% of the money, we'll be paying how much? 95%. It will now be 100. 100% minus 5% will give us 95%. And that is why we are multiplying this one by 95. That's why we are multiplying this one by 95. And if we do the computation, it should give you 1,140,000. 1,140,000. Then after that, we have the what? We have the import duties. We have the import duties. Import duties also is part of what? Sorry. So excuse me, sorry about that. So import duties is also what? Import duties also will be part of the cost. It will be part of the cost of the inventory. So we have the import duties, and how much are we told? They told us that 60 naira per unit. 60 naira per unit. So we have this to be 60. We have it to be 60. Then after that, we have delivery cost. Delivery cost of what? Of 5,000. Delivery cost of 5,000 also is important because we what is a carried inward. It's part of cost that we incur to bring the item from the point of need to the point, from the point of sales to point of need. So 5,000 also what will be added to it. So that's why we have 5,000 in there here. So the total addition of what will now be 1,205,000. The 1,205,000 is the total cost of the inventory purchase. So in our statement of financial position, when we are recording it, the cost that we're going to use to record it is what? Is 1,205,000. 1,205,000. So let's look at the next one, which is conversion cost. Conversion cost. Now we are still under cost. We have not left cost. But what we have done is when the cost does not involve the transformation, when it does not involve the movement of, when it does not involve the movement of one, when it does not involve the movement of, when it does not involve the conversion, when it does not involve you operating it or changing the form of the inventory before it can be what, before you can sell them. So, but if that's the case, it means that you have to what? You have to add the conversion cost to the total cost that you have incurred of buying it and bringing it down to the what? To the factory. Then also you will now continue by adding the conversion cost to it. So when material purchase from supplier are converted into another product in a manufacturing or assembly operation, there are also conversion costs to add to the purchase of the material. Conversion costs must be included in the cost of finished goods and unfinished work in progress. Conversion costs consist of costs directly related to unit of production, fixed and variable production overhead, which must be allocated to the cost of items produced and closing inventory. With other costs incurred in what? In bringing the inventory to their present location and condition. These are all the costs added together. So the conversion cost, for example, you have a flour, a bakery purchase flour. That flour is raw material. That flour is an inventory on them classified under raw material. You make use of sugar, you make use of yeast, you make use of other areas to actually bake. So once you have done that, it means that we are not buying flour and you're not selling it. So it means we have conversion rate. Your labor that you have employed to work on the flour. Number two is probably what the other costs that you incur in transforming electricity or part of it, in transforming to what? The flour into bread, and that bread will now serve as finished goods that will be used. It's possible also to want to take stock taking and to make sure some things are being done halfway. If things are being done halfway, you need to calculate the cost of the process in order to know the amount to what? The amount to use to compute the inventory. on the halfway. Okay. So now let's look at question 4. Question 4 says KCE manufacture control unit for air conditioning or conditioning system. The following information is relevant. Each control unit requires the following: one component X at the cost of 1,205 each, one component Y at the cost of 800 each, sundry raw material at cost of 150. So the company faces the monthly expenses. So we have each unit takes 2 hours to assemble. Production workers are paid 300 naira per hour. Production overhead are absorbed into units of production using an hourly rate. The normal level of production per month is 1,000 hours. Calculate the cost of a single unit. So we are asked to calculate the cost of a single unit. So how do we code on that? Remember that this is part of what? This is a part of question that have to address the conversion cost. So now, we want to produce 1 unit, we need 2 components. We need component X and component Y. So we have it here. And how many of component X we do know? We only need 1. And what is the cost? The cost is 1,205. 1,205. So we are done with that. The next one is component Y. How many units do we need? 1. So we have that where to go to be 1. Then after that, they say sundry raw material at the cost of 150. So we have that also. That's part of it as well. So addition of these 3 together will give us the total material. After we have calculated our total material, the next is now to move into what? Into the other costs. Other costs that will now be used to convert this raw material into finished goods. So the first one that we have here is that they say rent is what? Is 16,500. Now, with that rent, it means that if you have a rent and you do a lot of things there, or if you are producing 100, let's say you are producing 100 units or 150 units, it won't be reasonable for you to put the total cost of the rent in, or just to calculate 1 unit. You need to prorate it. And how do you prorate it? Yeah, okay, let's move on. Let's move on when you get there. Then I say energy cost is what? Is 7,500. It's still part of the total cost that we incurred. Then after that, they told us also that the selling and the administrative cost is 10,000. Each unit take 2 hours to assemble. Can you see 2 hours to assemble? That means that what cost of labor is there. So for 1 unit, you need to calculate the cost of labor. So you say, okay, labor cost is what? So okay, 2 units. Okay, each unit takes 2 hours to assemble. So we have 2 hours here. Production workers are paid 300 naira per hour. So it means that if 2 hours are used, then are paying them 300 naira per hour. The total labor cost for 1 unit is what? Is 600. You have to add it there because they are direct costs. Now, after that, it says that production overhead are absorbed into units of production using the hourly rate. Now, they now told us that the production the units are absorbed into the cost of the factory, the cost of the factory rent, and the energy cost are absorbed into each unit by what? By using the hourly rate. It means that it's per hour that they use to prorate the fixed or very overhead cost. So after that is said, you now say, okay, the normal level production per month is 1,000 hours. Now, if there's normally the normal level of production per month is 1,000 naira. Now, if the production level is 1,000 naira, what we need to do is now to calculate the total hours that will be used. Because factory rent here is on a monthly basis. It means 16,500 is what? Is for the whole month. Now, if this 16,500 is the month, what is the total units? What is the total unit that will be produced for the whole month? The total unit that will be produced for the whole month will now be what? How they so let's say sorry, let's say how what do they say? They say okay that we should use hours to prorate it. Then how do we use hours to prorate it? That's say the normal level of production per month is 1,000 hours. If the normal level per month is 1,000 hours times 2, that will give us what? Because we have 2 hours, that will give us let's take our calculator out. Let's take our calculator out. So let's take our calculator out. Okay. So in the calculator as now we have 16,000. So let's add all our costs together. 16,000 plus what? Plus 75. After that, that'll give us 24,000. 24,000. That if you give that give us 24,000, then you now divide it. If you divide it, that's 16,500 plus 75 divided by 500. Now that's what I'm trying to enact now. Now the normal level they expect to what? The total hours that is available for them is 1,000 hours. The total hours that is available for them is 1,000 hours, and they use 2 hours to produce 1 unit. So how many units will they now produce? The total unit they will produce will now be 1 hour, 1,000 hours divided by 2. So 1,000 hours divided by 2 will give us 500. 500 hours per. That's 500 hours. Okay, it means that 500 hours is what we are going to, so excuse me, 1,000 hours divided by 2 hours will give us 500. That 500 hours is going to use to produce for the components. If you want to produce for that's for 500 units that are going to use to produce. Then after that, we now say 6,500, 6,500 plus 75, that will give us 24,000. 24,000 divided by 500, that will give us 48. And that's why we have 48 here. So which means that this times more, it's not expected to be times, it's expected to be a division sign. It's expected to be a division sign because 1,000 hours is available for them, but it takes 2 hours to just produce 1 unit. So in order for us to be fair, we need to divide it by 2 so that we can get per cost per what? The cost per hour. That's why so that we can get cost per unit, cost per unit. So we now say, okay, if that is after doing that, it will give us 48. So 2,000, so 2,000 and 2,155 plus 600 plus 48 will give us 2,803. Then after that, so let us explain the net realizable value. Now, according to IS2, it says that the net realizable value means the estimate selling price in the ordinary course of business, cost or what? Because of ordinary course of business, cost of completion, and less cost necessary to be incurred in order to make the sales. So this talking about the what is the looking at the market price. What is the estimated selling price in the ordinary cost of business, less cost of completion, and what? And cost of necessary to be incurred in order to make the sale. For example, if you have not completed the conversion rate, the conversion from the raw material to finished goods, I want to sell it in between, then it means that you need to find the price that you are using to sell the finish less the cost of completion that you have not incurred. Then after that, you will now less other charges. Probably you advertise, probably you are paying anybody commission on the sales of those investment or sales of inventory and all that stuff like that. You need to reduce it. Then after you have reduced it, it will now show you what? It will show your net realizable value. It means that this is the best amount that you can gain or you can collect or you can be paid as regards to this particular inventory, as regards to the particular inventory. Then the net realizable value is the amount that can be obtained from selling of inventory in the normal course of business, less any further cost that will be incurred in getting to is ready for sales for disposal. And when I'm talking about this, net realizable value is actually the amount. So in that, when I'm talking about cost of what the normal cost of business is being transaction at what at arm's length. It means transaction that are being done at arm's length between two market participants. They are what? They are neutral. Between two market participants that they are neutral. So question 5 says that, okay, let's look at question 5 and let's start to address it in question 5. It says that a business has 4 items of inventory: a cut, of the inventory has established that the amount of inventory currently held at cost as follows. So we have inventory A and inventory B. We have the cost to be 10,000 and we have the sales price to be what? This is sales price. Now, if the cost is 10,000 and the sales price is what this and the selling cost is this, then now asks us to what? To pick using the cost and what? And the net realizable value. So what we do is that for the cost, you need the cost. So you just repeat this 10,000, 14,000. That's why we have 10,000, 14,000 here. Can you see under the cost? We have 10,000, 14,000. Then for us to get our net realizable value, we say that is the cost of what? The estimated market price, market selling price, less what? Less any cost of completion or any direct cost that have to do with what? The disposal of such inventory. Then we now have sales. So we have the selling price to be 85, and we have the selling cost, commission, transportation, calling, and everything. Everything is 500. It means that if I want to get my net realizable value here, I will now say 8,500 minus 500, and that will give me 8,000. The 8,000 there is the net realizable value. I'll now compare my net realizable value against my cost, because the law says that the lower that the cost that the amount that you use to value your inventory is the lower or what or between the cost and the net realizable value. So for project A, I'm going to use 8,500 to value for inventory A. For inventory B, I'm going to use 14,000 to value inventory B, because its R is lower compared to net realizable value. So let's look at the last part of this standard, which talk about cost formula. Cost formula, we have several type of cost formula. We have, but according to the standard, we expect to actually what to talk about the truth. So we have what we call FIFO, we have what we call weighted average. We have FIFO, we have weighted average. FIFO is first in, first out. FIFO is first in, first out. This method is based on the assumption that the material which are purchased first are issued first. They have been the word, because I purchased it first, it must go out first. Issue of what? Inventory at price in order of their purchase. So if I purchase any item of 20,000, if I'm issuing them out, I'm going to issue it at that amount. I'm going to issue it at that amount. So let's look at question 6 to check that out. Question 6 to check that out. It says that the following is the record of receipt of certain material during the month of January 2006. So they gave us the information. They say during the month, it sold 600 units as follows. So they say it sold this 600 units as follows. And I say compute the inventory value on 31st December or 31st January 2006 by FIFO method. So in order for us to compute it, because there's another thing for us to keep, or there's another thing for us to use cost, net realizable value. There's another word for us to use cost formula for us to ascertain the total value of inventory that we have at a particular period in time. So what we have is solution. So we have the receipt, issued, and balance. The receipt means that when you purchase things, an inventory and it's coming in, it falls under the receipt. The issue is when you are letting go of the inventory, it falls under the issued. While we have the balance. The balance is the value of the inventory that we have at the point in particular time. So then after that, we have the date. So we start with the date. Quantity at and naira sign are very, very important. The quantity means that how many units of item do we purchase. Then we have the at means that what is the price of each unit. Then the naira sign talks about the what? The totality of what we have bought, the totality of the inventory that we have purchased, the totality of the inventory that we have issued out. So if I purchase, let's say 10 units at the rate of 5 naira, it means my total amount of the inventory that I have purchased is 50 naira, because now be 10 times 5 will now give us 50. So for this one, let's look at this. It says that January to January 2 received 500 units at 20 naira. So we have the January 2 here, and it's under the receipt. So we have the receipt 500 naira at 20. It means that the total cost of it is what? Is 1,000. Then we put it under what? Under the debit, under the so because there's no opening balance, so we put it under the balance straight up. Then after that, it says that what? January 3rd receive 400 units at 21 per unit. Can you see? The price varies. The initial one is 20, while the other one is 21. So in order for us to do that, we now say January 400 at 21. Then multiply the two together, it give us 8,400. Now coming here, coming here, how do we arrive at this? Now if we are coming here, it means that 400 plus 500 here will give us 900. Then 1,000 here plus 84 here will give us 9,400. But at this art here, we just repeat the value of what we have, which is 2021. This 2021 means that we have what? We have items that have different purchasing rates. That we have an item that have different purchasing rates, and it should be taken care, it should be noted. It means that you purchase 24th before 21. It means we purchase 24th before 21. Now after January 3rd, there's what? On January 4th, we actually issue out 100 units. So we issue out 100 units, we have know that this one is 100 units. But at what rate? Will it be at 20 or at 21? But the what FIFO, since you are preparing using FIFO, it says first in, first out. Which one comes in first? 24 comes in first. So it means that out of 500, which is 20, we are taking 100 out. So the 100 times 20 will give us what? Will give us 2,000. Then after that, we repeat the same thing. So we now have 100 plus minus 900 will give us 8,000. Or 94 minus 2,000 will give us what? 74. But we are still having what? We are still having two different ones, which is 20 and 21. We still having two purchases of different amount, which is 20 and 21. Then we'll move on to January 15. January 15 says receive 300 units at 19 per unit. So we have 300 units here. We are receiving it at what rate? At 19 naira. So 300 times 19 will give us 5,700. Then for how do we get our balance? Our balance will now be what? Because it is an receipt, it will be 800 plus 300. That will give us 1,100. Then we have 5,700 plus 7,400, and that will give us what? 11,100. 30,100. So this is what? This is the balance. Now, if you look at this, we have 20, 21, 19. It means that we have three different rates of what? Of the total quantity of 1,100. Now, looking at January 17, now told us that 500 units actually were released. If 500 units are released, then we now need to compute. Remember, the first one was 500, and out of the 500, we have taken 100 out. So which means the total unit that we have at the rate of 20, because 20 comes first, with 400. We have 400 left. 400 times 20 will give us what? 8,000. So we have that there. Then the next one for us to now break, okay, what else do we have? We issue out 400. So it means 400 minus 500 will give us 100. So we need to issue out 100. At what rate will you issue out this 100? We're going to issue out the 100 at the rate of what? At the rate of 21. At the rate of 21. At the rate of 21. Because we have exhausted 20, the next one is 21. So we put 21 there. Because 400 at the rate of 21. So we put 21. Then we now have 2,100. 2,100, which is what? Which is the multiplication of 100 and 1,000. After we have gotten that, the next thing is now for us to add. So we now look at this. Okay, 400 plus 100 will give us 500. 500 minus 1,100 will give us 600. After that, also we repeat the same thing for the total naira. We now say, okay, fine. 8,000 plus 2,100 will give us 10,100. 10,100 minus 13,100 will give us 3,000. So it means that the balance that we have as at June 17 is 600, is what? Is 33,000. The value of the inventory that we have is 3,000. Then we now say at the June 8th, 2028, we receive an item. What item do we receive? We receive 300 at the rate of 20, which will give us 8,000. And that will actually will give us the balance of 1,021,1920. Okay, so the other one that we have is what? Is the last in, first out. That's LIFO. LIFO is the opposite of first in, first out. So what I've explained, if you are using FIFO, you can use it other way around. So please, you can make an attempt on that and solve that out, okay? Then after that, we have weighted average. Now, weighted average is actually what? This under this method, the quantity of material purchased in various lots of purchase is considered as weight on while pricing the material. Weighted average that every quantity that we have purchased, every what the value, every value that we have received at a particular point in time that we have purchased, add everything together, divide it by the total units that we have purchased. That will give us the price per unit. It means that every time you'll be having just a single price to use to value both your outer, you use to value your outflow and also for your balance. It will be used to value your outflow and balance. So we have question 7 here. Question 7 here says that we should use FIFO and what? And average. This is average weighted method. Now this average weighted method or average weighted cost is actually so just use the same table. Use the same table, and if you have any question, please ask me. Ask me if you have any question. I'll leave this. So my assignment for you is on question 7. Solve question 7 and get back to me. So I will review what you have done on that. Then I will attend to your solution. So do question 7 and send back to me. So our time have been fast spent. So I apologize for taking too much of time, for taking extra time. I apologize for taking extra time. So please do find some time. Do find some time to solve question 7. Do find some time to solve question 7 and revise what we have done so far. I'll revise what we have done so far. So I'll just give like 2 minutes if there's any question. I'll give like 2 minutes if there's any question. Okay. In the absence of any question, Mr. Hashem, thanks you so much for joining today's class. This will be the end of today's class, so we'll see you in the next class, okay? Thank you very much.